Hello and welcome. You've tuned into Business Lunch. I'm Nisha Podar and with me is my co-anchor Sonal Bhutra. Let's begin with the market action for the day. And at the moment, it is showing some signs of weakness when it comes to the overall markets. There are various global cues which are really weighing heavy on the market. So at the moment, Nifty 50 about 17,890 odd levels with a cut of about 50 points. Sensex 2.3% down in trade. It's a bank Nifty which is showing some amount of outperformance when it comes to the overall indices, and that is down almost on a flat line with a huge negative bias, and mid caps too outperforming the key indices but still is trending on the lower side. Advance decline ratio in favor of the advances with the mid cap universe performing slightly better. On my screen at the moment, Kotak Mahindra Bank over 2% gains in an otherwise weakish market. SBI also doing extremely well. So these are the two big counters and the heavyweights which are keeping the bank Nifty at a more stable levels in an otherwise weak market. Bharti Airtel also gaining in trade at the moment. Sonal.
Yes, it's a very stock-specific market, but of course, it's the weekly options expiry as well. So the last 1 hour of trading action is something we'll be watching out for. After 5 days of continuous rally, US markets did see some profit taking today, and that's visible in our own markets, though we have recovered a tad bit from the lows of the day. But as I said, it's a stock-specific market. So Sona BLW, that is the stock on our radar. It is losing today after a block deal where PE firm Blackstone is likely to have sold a 13% stake. Sonia Shenoy is here with all those details. Hey Sonia, good afternoon.
Well, thanks a lot for that. It's a rather large deal that took place on the exchanges today with Sona BLW, where, as you rightly pointed out, 10.2 crore shares, which is 17.2% equity, changed hands in just one deal, worth 5,200 crores. Now, this happened at a price of 510 rupees, which is lower than the current market price, and hence you're seeing the stock gravitate towards that level. Now, sources have told us that Blackstone is likely to have sold 13.6% stake out of the 17.2% total deal that happened. Blackstone was in any case looking to raise money. They have in all likelihood raised a little over 3,500 crores through this block deal. Blackstone held about 34.1% stake as of June 2022. So large deal is what has taken place in Sona BLW today.
Thanks so much, Sonia, for getting us all those important details. Of course, private equity exits whenever the window of opportunity is open in the equity markets is to be seen and will be the theme going forward as well. Now, the Indian pharma companies see a sharp correction after the ranitidine dispute settlement in the US spooks the generic pharma stocks. In fact, our in-house pharma expert, Ekta Batra, is right here with all the details on this development. Ekta.
Well, yes, it's a down day for frontline Indian generic pharma companies such as Sun Pharma, Dr. Reddy's and Cipla. Now, while analysts and experts can't pinpoint a specific reason for the weakness today, there is a likelihood that the correction is on the back of the US generic stocks such as Teva, Perrigo, as well as Taro correcting overnight in the US markets. Analysts say the market seemed to have been spooked by a settlement on the popular antacid drug Zantac and Zantac generic, or the chemical name ranitidine. Remember, the drug was pulled out of the US in 2020 by the US drug regulators on fears that the drug contains a cancer-causing substance, NDMA. Now, the lawsuit was against some of the manufacturers of the branded and generic versions of Zantac by a 79-year-old man, Joseph Bayer, claiming that the drug which he bought over the counter and consumed caused his esophageal cancer. The generic pharma companies such as Teva, Perrigo, Sun, Dr. Reddy's made a combined settlement of over $500,000 with Bayer a week before it went to trial. Now, the settlement amount of the combined 500,000 odd was not that much and will be less than if the case went to trial. But the news has cropped up fears that the other similar lawsuits on ranitidine could result in a liability litigation, which could end up costing billions of dollars to resolve. Also, while litigations on generic drugs is a normal course of business, the fear is the large number of cases for ranitidine. Reports indicate there are currently more than 2,000 lawsuits in the US against manufacturers of ranitidine on allegations of it causing cancer. A US-based brokerage house that wrote on the matter indicated there is substantial uncertainty surrounding the total financial impact of the Zantac litigation. Lastly, the fear is that NDMA has also been found in other drugs in the US, such as sartan drugs, which are used to treat blood pressure, or the extended release version of commonly used diabetes drug metformin, hence cropping up fears of similar type of litigations on those drugs. Also, the street continues to fear factors such as price pressure and factors such as the US president signing a law to lower prescription drug prices, heightening concerns around the same.
Ekta, thank you so much for joining us with that analysis. And with that, we'll slip into a break now. But here, as we do that, here's a quick reminder for our viewers. It's that time of the year again. Money Control Pro's Financial Freedom offer is back with added benefits. Get a Money Control Pro subscription at net zero cost by claiming exciting offers worth 1,500 rupees from our partner brands. Grab the benefits now only on the Money Control app or the website. Welcome back. You're still watching Business Lunch on CNBC-TV18. Well, let's talk about an important story now. The Central Board of Indirect Taxes and Customs has issued detailed instructions for issuing summons under GST provisions. My colleague Timsi Jaipuria is standing by with the details on this one. Timsi?
Well, in a major relief for industry, for GST taxpayers, the Central Board of Indirect Taxes and Customs yesterday came out with a detailed instruction on how the officers investigating various cases of tax evasion should consider what is the checklist that they should consider before issuing summons, before issuing arrest warrants, and what could be provisions under bail also. And when it comes to summons, something that the industry was wanting clarity from the government, something the industry has been batting for, has got its way, and a major overhaul in this is that summons should be done by superintendent only after written permission of senior officers. It should indicate name of offender against whom the case is being investigated. The summons may avoid for calling statutory records as available on GST portal. Also, summons should not be issued to top senior officials like CMD, MD, CEO, CFO to call for evidence or documents in the first instance. So the superintendent who is investigating the matter should first call for records, should first call for maybe a representative of the company to come forward and not issue blatantly summons to the top management asking them to appear before the GST authorities. Also, it says that the summoning officer must be present at the time and date on which the summons have been issued. The issuing repeated summons should be avoided without ensuring adequately whether served upon properly or not. So these are detailed guidelines, detailed checklist that GST authorities, the top management wants that the officers who are investigating the matters on the ground, on the field level, should keep in mind before issuing summons, before issuing arrest warrants, and also exercising the option of, because there are detailed guidelines of bail also available. So if a company or an officer is contesting against the bail, then also he should, what is the checklist that he should keep in mind. Definitely a big benefit for the industry, because now what we were seeing that top management was being called in the first instance itself.
Yes.
So that is a breather.
Yes, Timsi, very important point that you mentioned on the last bit that you mentioned on the corporates being summoned on the very first instance. So there is a breather for corporate India on that particular front. But more taxing times and more charges there. We're hearing the restaurant services charges case. The Delhi High Court has directed a stay on the CCPA guidelines, which means that restaurants are free to levy service charge till the next hearing of the case. My colleague Ashmit Kumar has been focusing on this development. Ashmit, this matter is of importance and interest to all of us here. So tell us, when is the next hearing and how is the hearing going in what direction? How important is this particular hearing?
Well, just for the benefit of our viewers, if we can give some context, the CCPA, the Central Consumer Protection Authority, had come out with guidelines barring the levy of service charged by restaurants. Subsequently, the matter reached the High Court, and the High Court in the month of July had stayed those guidelines, allowing the restaurants to continue levying service charge. That order, that stay order, was challenged and then was heard again once today. And today again, while the CCPA pressed on for in fact vacating that stay for levy, for ensuring a bar on levy of service charge, the Delhi High Court so far has not obliged. The Delhi High Court has allowed for that stay order to continue. So the restaurants, as of today, can continue to go on and charge service levy service charge. The next hearing, we understand, is on August 31st. But having said that, there was a fierce exchange of arguments between the two sides. The CCPA argued that the levy of service charge, they received lakhs of complaints, that this affects consumer welfare, that as far as levy is concerned, the restaurants are free to, in fact, raise the prices of their commodities, but that service charge is simply unsustainable, that the CCPI is acting within its powers. The restaurants on their part said that, look, this is a practice that's been carried on for over 70 years, that any increase in prices would unduly benefit Zomato, the likes of Zomato, Swiggy delivery applications, and went on to say that, look, government has no business controlling prices or charges that are levied by restaurants. These are private contracts entered into between restaurants and customers. The Delhi High Court gave an interesting observation, however. The Delhi High Court observed that restaurants are bound in law to pay their employees, and that obligation cannot be transferred to the customers, that service charge, that tips essentially is a discretionary feature and cannot be made compulsory. That was an observation that fell from the High Court. But nonetheless, the stay continues. Restaurants free to charge service charge, and the next hearing, we understand, will be on August 31st.
And we'll come back to you, Ashmit, for those updates. And, you know, Nisha, as we were discussing, as Ashmit also said, one of the arguments was add it to the commodity or the product prices, but don't charge it as a service charge.
But the price looks inflated, so you add it when the bill comes. So that is also one way of charging.
And a lot of hotels or restaurants, for that matter, even after this ruling that had come out, would say, sorry, we will still charge you service charge. It's not an optional thing anymore. So we are still obliged to pay it. So there is no...
So there is a Supreme Court observation which Ashmit was highlighting, and I'll take that as the biggest takeaway, that it cannot be compulsory on the customer. If you have objected to it, then probably the restaurant. So that's a matter of debate.
Absolutely. So, of course, we'll keep discussing that. But for now, we'll slip into a break. Before that, we'll hear out Tata Power's MD and CEO Praveer Sinha talking about how the company will be the first to set net zero targets by 2045 and is working towards achieving sustainable operations across its businesses. Tata Power believes sustainable is attainable by making small changes today for a sustainable tomorrow.
Watching Business Lunch and take a look at the markets. In fact, some bit of ground being covered in terms of limping back and moving towards the green. Nifty 50 crosses 17,900 level at the moment. Bank Nifty has moved to the green zone. And in fact, the charge really for the relief is coming in from some of the key banks like Kotak Mahindra Bank as well as ICICI Bank. So keep an eye out on the market at this point. Moving on to some important news developments of the day. Well, the RBI has released a discussion paper on the aspects related to the charges in the payment systems as well as the various payment instruments. In fact, my colleague Ritu Singh joins in with all the details on the discussion paper and what it could mean for the industry. Ritu.
Well, yes, RBI has released a discussion paper on the charges levied in payment systems, but importantly, it has not taken a stance on these just yet. What it has done is raise questions on a wide range of issues and sought public feedback on them by the 3rd of October. Broadly, these questions ask if digital payment charges should be market determined or regulator prescribed and how they can be made more transparent. Now, for instance, for funds transfer, like your IMPS, RTGS and NEFT, RBI asks if charges should be prescribed or if there should be a cap on IMPS charges, etc. Debit cards, as you know, is the only merchant payment instrument where RBI has intervened to bring down charges, and here it is seeking feedback on whether regulatory intervention is required or if stakeholders can decide on an optimum level of MDR and interchange rate, and if RuPay debit cards should be treated any differently from the rest. MDR, as you know, is the fee that is paid by merchants to the banks for processing payments. Now, on credit cards, and this is important, RBI so far has not issued any mandate or intervened in the charges, even for PPI-based merchant payments or fund transfers. And this paper has sought feedback on this front as well. It has also sought feedback on, for instance, if people pay their credit card dues ahead of time, shouldn't that get reflected in lower MDR and their CIBIL scores, etc.? UPI is also under the scanner, where the government has mandated a zero-charge framework for such transactions. Now, this paper looks at general feedback in the context of zero UPI charges and asks if subsidizing cost is a more effective alternative, and if UPI transactions are indeed charged, should MDR for them be a percentage of the transaction value or a fixed amount, etc. It also looks at payment intermediaries in areas such as surcharge, convenience fee, etc. Now, while there's no real giveaway in terms of which way RBI is leaning, declining. But if you do look at their payment vision document, affordability for customers and greater digital adoption is desirable. So unlikely that charges will go up significantly for customers. If they do, they might be borne by banks, fintechs, etc. But the impact on banks and payment companies because of these changes in charges will be significant to watch out for.
Of course. Ritu, thank you so much for joining us with all those details. Let us also get in some important exclusive commentary on global economic trends coming in from MasterCard CEO Michael Maybach in conversation with our managing editor Shireen Bhan. Listen in.
I resisted using the R word in our last conference call with the analysts and investors. And frankly, that's for a reason. If we think back about the financial crisis, 2008, 2009, if you look at the state of the world then, vis-a-vis the state of the world, we don't have an asset bubble. What we have on the other hand is we have high, strong employment. I mean, unemployment numbers have gone down since pre-crisis. So we are in good shape. We have had many stimulus programs here in India, the US, and Europe that went to individual consumers. The consumer balance sheet is much stronger than it was back then. So if you then look at that underlying thing, yes, there is pressure on energy prices, there's pressure on air tickets, we just talked about that. So there's some inflationary pressures, but you also have more decisive actions from central bankers around the world who are stepping in to halt the inflation or prevent a further increase. So gives and takes, puts and takes around inflation. And I've not yet said the R word, and I will not. So we'll see.
You don't believe we're headed. You don't believe we're headed into a recession?
In the short term, we are seeing that inflationary pressure will prevail, but the actions that central banks are taking, we believe, will take hold. So then it's important to think, if we make the bridge to our business, not everything that is driving inflation is reflected in our business, because where digital payments generally happen, the types of digital payments that we do is oftentimes not in rent, for example. It's oftentimes not in types of energy prices when it comes to utility payments for natural gas or things like that. So our basket vis-a-vis the overall CPE is a different kind of basket. And hence there's why there's some cushioning happening as well. Fundamentally, as price levels increase, there's a short-term benefit in volumes, but that is something that is generally passing, because overall, if inflation prevails for a longer time, it's not good for anybody. So we believe that the government actions that are being taken, particularly by the central banks, are showing effect. We see it in the United States. You see it in India. Actually, your inflation rates come down.
All right, let's move to the energy market developments. And new OPEC Secretary General Haitham Al-Ghais says that OPEC is not the reason for rising inflation, and there are other factors which have led to this spike. Here's an excerpt of an exclusive conversation with CNBC's Hadley Gamble.
If you look at history, if I may, I mean, such challenges are not new to OPEC and the OPEC history. I mean, we've had the Iraq-Iran war in the 80s, you had the invasion of Kuwait in 1990. And this is, I don't want to say pretty normal, but within the context of the alliance we have with the non-OPEC producers, still Russia is playing a prominent role. Russia is producing around 10% of global oil production. They are playing their role within the wider framework of the Declaration of Cooperation.
But a country that destabilizes the global energy market, how do you trust them as a partner?
Well, I mean, we try always in our meetings to separate the politics and the political aspect from what we do in terms of managing the market balance. And in terms of what we do as OPEC Plus, I think the methodology is clear. Russia's leadership in supporting this Declaration of Cooperation has been clear since day one, since 2017. And it's, the relationship is solid there in terms of managing the market.
So you trust Russia?
Yes.
Okay, that's the word coming in from OPEC, and that's all the updates that we have on this edition of Business Lunch. But quickly taking a look at the markets, still down but not out. We have Bank Nifty, which is sitting with flat losses, down around 4 odd points. Take a break on this edition of Business Lunch. Stay tuned. Mid-Cap Radar comes up next.